Good morning, good afternoon, good evening, everyone joining us today to have a conversation on GIPC and GRA matters. Thank you so much for responding to the invitation from the UK Ghana Chamber. And as we usually do, this session is not expected to go beyond 2 hours. As we can see from our individual screens, our quarterly tax dialogue series topic for today is technology transfer and tax, the role of the GIPC and GRA. Thank you to the team at the UK Ghana Chamber for putting this together, ensuring invitations go out, and then coordinating our efforts as usual to ensure that at the end of 2 hours, we would have gotten a bit of insight, both from practice and public sectors of our economy. Joining me on today's panel, as you can see from your screen, are representatives from the Ghana Revenue Authority, the Ghana Investment Promotion Center, and PwC that collaborates with the UK GCC to put together this dialogue series. For those of you who joined us during the last conversation on transfer pricing, I'm sure you would remember the faces of Moses and Kingsley. And Moses and Kingsley would like to say thank you so much for joining us to complete the conversation that you had about 2 months ago. Moses heads the transfer pricing unit at the Ghana Revenue Authority, whilst Kingsley heads the transfer pricing and the mergers and acquisition unit here at PwC. For the images that you see in the middle, our lady is the head of the legal division and the board secretary of the Ghana Investment Promotion Center, Nalamle Olansi. Now, thank you so much for joining us today to complete the conversation that Kingsley and Moses started the last time. And in between Kingsley and Na, you have Michael Klobodu. Michael is a senior manager at PwC, and he leads the company secretary and regulatory aspects of the business here. Kingsley, Michael, Na, and Lamle together have over 70 years of professional experience, and we hope that they will help us navigate the roles of the GIPC and the GRA in our tax dialogue series for today. As we typically do, our agenda is in 3 parts. So as usual, I'll try as much as possible to present the background. Then we get into the panel conversation. And then lastly, you have the opportunity to ask your questions. So right into the background, for those who joined us about 2 months ago, you would remember this particular chart or this particular slide, whereby all the businesses would typically be set up to get a return on their investment. You would usually have revenue, you would spend, you may have to account for depreciation, you may have taken some loans for which you need to account for before you arrive at your income tax. And lastly, you may have an amount which you may choose to distribute or re-employ in the business. You would recall this particular table, which is just an illustration of how revenue from 120,000 ended up being only 12,000 possibly available for distribution or for reinvestment in the business. We actually assumed that this was a case where there was no issues. In other words, the Ghana Revenue Authority was probably happy with this. The GIPC had no concerns, no regulatory issues came up, and then you may arrive at just about 10% of the revenue that you started with. However, in certain instances, or just before we get there, these numbers that we see are actually being informed by so many things. So if you have, say, an entity here in Ghana that have related parties across the world, so as you can see from the image to the left of the screen, this entity here in Ghana, you may assume it's company A or company B. It probably gets services from the group, probably receive finances from another aspect, receive products for sale, get some marketing support, amongst others. As a result of these relationships, prices may be influenced. Prices may not be charged at the same level that may be charged to an independent person. So what you may therefore realize is that close to the revenue of 120, someone may say that my revenue is just 110. My cost is no longer 90, but 95. At the end of the day, by just tweaking those two numbers, you see that in the previous case where we had a profit of 12,000, now we are landing at just 750. Consequently, tax also drops from about 4,000, or income tax drops from about 4,000 to 250. As a result, you may have the GRA being interested. You may have the GIPC also having an interest in these particular matters. So for instance, the GRA may come in, which was part of the conversation that Kingsley and Moses led us to have last 2 months. The GRA may come in and say, no. Your revenue is not 120, but your revenue should be 130,000. Your costs is not actually 90, but probably 85, or whatever the magic number is. And from there, a profit that is showing of about 12,000 or 750 can go all the way to 23,250. Just by way of reminder, and I'll be inviting Moses and Kingsley in soon, you would recall that Moses and Kingsley kept referring to the fact that for transfer pricing purposes, one would need to justify the price that is being charged to a related party, used loosely. However, in certain instances, the price that may be charged, you may not need to have an adequate, or you may not have to have extensive transfer pricing documents to support those charges. And I recall Kingsley and Moses mentioning that if you have a registered technology transfer agreement, then you do not need to have detailed transfer pricing documentation, but rather the documentation from the GIPC may be sufficient for you not to complete that. So maybe at this time, I would be showing you this part shown in red blocks. So maybe I would call in Moses first, and then maybe later Kingsley, to let us know or to recap the circumstances under which a registered technology transfer agreement from the GIPC may be sufficient, and hence we don't need a detailed transfer pricing documentation. So Moses, are you able to help us to recap that before we get into the detailed panel discussion soon? Thank you very much.
Thank you, Abeku, and good morning, good afternoon to our guests. Yeah, so Abeku, as discussed, under the transfer pricing regulation, we have a safe harbor for technology transfer agreements that has been registered with the Ghana Investment Promotion Center, and the safe harbor provision, which we call simplified approach. Simplified because we are trying to take off some of the burden in the form of maintaining what we call contemporaneous documentation, that once your TTA is registered with the center, that is the first condition. Your agreement should be registered with the Ghana Investment Promotion Center. And then 2, the amount that you are charging should be in line with the provision of the transfer pricing regulation. Specifically, if you are charging royalty, the royalty that you are charging should not be more than 2% of your net profit. If it is know-how, the amount that you are charging should not be more than 2% of your net profit. And the same for management and technical services fee. So the first condition is that the agreement should be registered with the center. And then 2, the fee that you are charging should be in accord with the 3 indicators I've mentioned. And then the 3rd one is that you must write to the Commissioner General to elect to benefit under this safe harbor provision. Once you satisfy these 3 conditions, you are not required by the transfer pricing regulation to maintain what we call the contemporaneous documentation, which is the local file and the master file. The only things you are required to do is to file a transfer pricing return, which is just a disclosure return. Then you disclose the nature of the expenditure, the services provided, and that suffices. And the revenue will look at that. Because the issue of the maintaining master file, local file comes with a lot of cost, and a lot of time will be spent by either your internal resources or procuring the services of a consultant to put these documents for you. So if you are to go under the safe harbor provision under regulation 14, specifically 8, sub-regulation 8, what means is that the burden of maintaining a local file as well as a master file has been taken up once you comply with the 3 basic requirements. I think that is just a recap of what we discussed and what the regulation requires in terms of benefiting the safe harbor provision under the transfer pricing regulation LI 2412. Thank you.
So thank you very much, Moses. And I believe this is a very good recap, especially for those who missed our conversation last 2 months and why there was the need to get a GIPC on board for us to complete the conversation. This may appear as an obvious point, but I would like Kingsley to come in to emphasize the sort of things that these exemptions may apply to. So for example, somebody may be asking, does this apply to the sale of goods? And if you look on the slide, does it apply to the portion that may be shown in black dots? Or these applies to particular kinds of payment? And if yes, what are the kind of payments? So Kingsley, if you could please clarify that before we continue with our conversation. Thank you very much.
Thank you, Abeku. Good morning, good afternoon, our audience. Yeah, to answer your question directly, there are 3 buckets of items or expenses or costs which can actually qualify for this exemption from preparation and submission of transfer pricing documentation. The first one is royalties. Royalties is basically the payment you make for the use of intellectual or industrial property rights, right? We know that things like how to make products that we use, the real owners have actually registered it, and you cannot use it unless you are licensed or you are permitted to. So when the owner of an intellectual or industrial property rights, it could be patents, it can be know-how, actually grants you that right to use it, it would ordinarily fall under what we call royalties, and you make payment for it. That payment is called royalty. So royalty payments falls under the exemption. And as Moses indicated, if the payment is not more than 2% of the net profit of the entity, then you will be entitled to make the claim. Actually, the right to be exempt from preparing the documentation is not automatic. You need to make an election in writing to the Commissioner General within 30 days upon entering into that agreement. The second bucket of expense is actually management fees. Management fees. And there's also know-how. That's the third one. All of them have 2%. So Abeku, you are right. Goods, supply of goods is not part. Obtaining loan, for instance, is not part of it. These are the three buckets. And the basis of the exemption is that the payment under the agreement should not be more than 2% of net profit. And again, I think we need to look at the election process. I've touched on it already. So the requirement is make an election to Commissioner General within 30 days after entering into the agreement. The first point is that you also must get GIPC approval before you can actually make this election. So if you have a TT, a technology transfer agreement registered with GIPC, then you can make that election, not to prepare and submit TP documentation. We know in practice that GIPC approval process can last more than, or usually will last more than 30 days. So if two companies, A and B, enters into an agreement today, in order to benefit from the reduced documentation preparation burden, they must get to GRA's Commissioner General within 30 days. I am submitting that it's really impracticable for companies to make an election to benefit under this provision. And I mean, you introduced me by saying that I lead a transfer pricing unit at PwC. None of my clients has taken advantage of this because it's impracticable to actually achieve that. And Moses, I think if we look at Regulation 1410 also, it's not only the election that must be made. You must actually attach to your annual transfer pricing return certain details. One of the details in there is for you to provide a justification, but the law calls it rationale. The rationale for the transfer of the technology, technology transfer within the context of the business. Now Lamle is here, she would speak soon. She would normally take every application and review it rigorously. By the time she's done, by the time the approval is given, the need for the service or the transaction would have been confirmed. So I feel that if we are truly really trying to reduce the administrative burden and also the cost of really complying, we could consider eliminating the need for a taxpayer providing the rationale or the justification for the cost. I mean, because the presumption is they've met the GIPC requirement and it's been approved, so the justification will be there, you know, and truly they are not paying a significant amount, they are paying up to 2%, which to GRA will satisfy the arm's length principle. So then on that basis, you know, GIPC could consider further reducing, if I may put it there, additional disclosure requirements provided under the simplified approach to the law. Thank you very much, Abeku. Happy to take any additional follow-up question.
All right, so thank you very much, Kingsley. And as obviously we can see, the conversation would very soon get into the arena of the GIPC. Now, on the next slide, you would recall that the conversation we had the last time was that having a transfer pricing arrangement is not necessarily illegal, okay? It is not necessarily illegal. However, to protect the tax base, some adjustments may, however, be made. So if you look at the boxes in red, and you take a look at the line for G&A, where Moses and Kingsley have explained that the simplified approach only applies to particular services, particular use of intangibles. For instance, royalties, know-how, management and technical services fees. Then you may have an instance whereby, as you can see, if you do not get a GIPC approval, your last column would actually show you that your deduction of, say, a 5,000 for G&A expenses may not be allowed. So one may want to find out, what then can I do to get a GIPC or approve my technology transfer agreement? So on this particular point, I would like to invite Nalamle to first explain what a technology transfer agreement is, whether or not it really applies to all forms of entities, and what is the procedure in really getting those agreements approved. So now, if you can hear me, please feel free to come in. Thank you very much.
Thank you very much for the opportunity, and good morning and good afternoon to all the participants joining into this most interesting discussion. So what is a TTA? And when I say TTA, I mean Technology Transfer Agreement. So I'll be using that abbreviation as we go along. So very basically, a TTA is an agreement, a contract between two or more parties. As the construct of the law, it is one party, generally is in Ghana, a company in Ghana, whether wholly, partly, or foreign owned, or wholly Ghanaian owned, which enters into an agreement with a company outside the shores of Ghana for the provision of services. Now, these services are specifically management services, know-how services, technical services, and industrial property services. That is patents, trademarks, trade names, and the like. So you have an agreement between these two parties. The Ghana company is a recipient of these services, and these services have to be paid for. So the agreement basically is a transaction between two companies or two or more companies, one party residing in Ghana, the other party or parties residing outside Ghana, and the Ghanaian party receives these services for a fee. That very basically is a TTA. Now, the GIPC Act 2013 at 865, which is very available, freely available on the GIPC website, or you can just Google it, you get a copy of the law, mandates the GIPC to register such agreements. Registration here means that once the companies enter into this agreement, a copy of the agreement, an application form, and some documents are submitted to the GIPC for registration of the agreement. Now, this applies to all companies in Ghana, irrespective of the sectors they are operating in. So whether it's banking, insurance, mining, hospitality, it cuts across. Once the company in Ghana elects to have an agreement with a company outside Ghana to receive these services, then it would be a TTA. In our experience, majority of these agreements are done between related companies. That is usually they are multinational companies with branches or subsidiaries in Ghana, or there are companies in Ghana who need to use trademarks or trade names of foreign companies as a franchise arrangement or agreement. This is the bulk of the agreements that we see. So irrespective of the sector of operation, irrespective of your sector regulator and the rules and laws of that sector, you're obliged, if you have such an arrangement, such an agreement, to submit it to the GIPC for registration. Now, as has been said before, this applies to services and not goods. So if you find yourself in this situation, you submit it to the GIPC. Our website has a lot of information on the process. In summary, you submit the agreement and you submit the forms, and the number of documents to add. I don't know whether we time to go into the nitty-gritties of what the procedures entail, but key to mention is that there is a regulation, that is a transfer regulation 1992 LI 1547, as well as the act itself, that mentions very specific information that must be within the agreement and information that must not be in the agreement. So the law will tell you, you must have these elements in your agreement and you must not have these elements in your agreement. So what GIPC does basically is take your agreement in line with the law and then try and determine whether you are in compliance or not with the provisions of the GIPC Act, and inform companies accordingly. If you're in compliance, we'll proceed to finalization and registration. If not, we'll ask you to make the necessary revisions to your document and resubmit it. So that, in summary, is what a TTA is, who it applies to, and the basic procedures for submission of the document to the center. Abeku.
All right, so now thank you very much. So in brief, and please keep me truthful here. In brief, the agreement or the requirement to have the agreement registered with the center applies to all entities without exception. 2, you have made reference to the 1992 regulation. And the position of the center is that the regulation has survived the 1994 Act and also survived the 2013 Act. And then 3, the center would check whether you are complying with the regulation before your agreement is registered with the center. Is that correct?
Yes, so generally that is correct. There are a few exceptions which we may go to in later, but generally that is a reflection of the matter on the ground.
All right. So just to put the conversation in context, we recall 2 months ago, we had a transfer pricing conversation. We were told that in certain circumstances, we don't need to go through extensive documentation. And one of the conditions under which that applies is if we have not just a technology transfer agreement, but a technology transfer agreement registered with a GIPC. We have now been informed that broadly, the requirement to have your agreement registered, if you are engaging in activities that makes you pay royalties, makes you pay for know-how, management and technical services fee, beyond a period of 1.5 years, then you should be approaching the GIPC. Kingsley mentioned that in practice, a lot of his clients don't go through that because you may not meet the 30-day requirement to be able to get your registration done. Now has also mentioned that there should be certain things that that agreement should contain. So at this point, I would like to invite my last panel member who is here to speak, Michael, to let us know what are some of the key elements, because the object is we want to ensure that if we can avoid detailed transfer pricing documentation, we avoid it. And one of the routes is through the GIPC. Michael, what are some of those key ingredients or elements GIPC would want to see contained in an agreement before that agreement would be registered?
Thank you, Abeku. Good morning, good afternoon, our audience. Yeah, so to move straight to Abeku's question, every technology transfer agreement must have certain mandatory clauses as specified in the technology transfer regulation of 22. Now, some of them would include the following. So every agreement must actually have parties who have a transferee, transferor, which must be known in the agreement. And so with the parties, there's someone who is actually receiving the technology and there's someone also actually delivering the technology. then basically in it there must be definitions, of course, to actually explain the various words and phrases that have been used in the agreement, so that anybody who reads it could actually understand exactly what the content is about. Then in it there should be a commencement date. Now, on the commencement date, typically here we are saying that it's the date on which the agreement will start, the date on which the agreement would commence. Now, sometimes if you state the date in the agreement and it happens that the date on which it will commence comes, before it is registered, what it will mean is that that date may not be applicable. And so more often, the date of the commencement should actually conform to the date of registration. And so that's what it means. Now, it must also have a duration. The duration of the agreement must actually be within, 18 months to about 10 years, which typically is the case, because we all know that an agreement for a delivery of services below 18 months would actually not wouldn't have to come to the GIPC for registration at all. Now, and then also, so to state again, when it comes to the duration, 10 years is for the agreement in the first instance, and then we do also have 5 years in the case of a renewal. Then we also do have a situation where the detailed description of the service would have to be provided to enable the GIPC to evaluate and determine whether, one, it actually qualifies as a technology transfer, and two, to also determine whether the service in particular actually requires an external person to deliver it. Because what we have come to know is that there are firms in Ghana who can actually deliver some of these things. So the detailed description is very, very important. In the agreement, the fees must actually be stated. And so if you look at Regulation 14 to 17 of the LI 1547, the various fees have been outlined over there. Typically, if you take a look at fee for industrial properties, it ranges between 0 to 6%, inclusive of know-how. And then if you look at a technical service or technical assistant, it ranges between 0 to 5%, also including know-how. And then when it comes to management service, it ranges between 0 to 2%. But that will be based on a pro rata. That is, if the person delivering providing the management service has interest in terms of equity in the company, then what's going to happen is that the more, if the equity interest is 60% or more, definitely as it increases to 70, 80, the amount of fees that can actually be charged also reduces. Now, there must be a provision for taxes. Obviously, if the fees are to be paid, assuming the agreement is approved and fees are to be paid, obviously, whosoever is receiving the payment would have to pay a withholding tax on the fee. So clearly, this would have to be stated in the agreement. Now, there are other clauses which will also include the governing law, which must be, of course, the laws of Ghana. Sometimes, the funny thing is, some of the agreement, when you receive them for the first time and you go through it, people will state, well, UK's, people will state other jurisdictions, but most of the times it's supposed to be Ghana. So that is also very, very important to take note of. Now, there is the need also to have, a training program, cross-for training program in it, and the training program must actually have a detailed description of the program. You know, the thing is, it's a transfer of know-how. So the processes of training people within the company so that they can also gain the knowledge is very key. And so that's why there's the need that, you know, provision for training program will have to be made. And so quite often what happens in practice is that there will have to be a kind of a sheet or a document to outline the various training schedules that the company will be embarking upon throughout the period that, you know, the agreement will be running. Other clauses to be included also would include, you know, indemnity and limitation, breaches and termination, force majeure, you know, and others. So there are a number of things that must be included. One key thing that I need to mention, of which I cannot ignore, is actually dispute when it comes to, you know, dispute resolution. If you look at the regulation, the LI 1547, we have a dispute provision in there, which must actually be adopted into the agreement. Now, this aspect of dispute is that the suggestion is that in the very first instance, if there's a dispute, it must actually be resolved between the parties through some form of a mutual, you know, discussion. Now, in the event that that should not work, then the parties may have to look at, you know, other means whereby probably they may resort to arbitration procedures, you know, using various, you know, rules that the regulation has actually established. So basically, these are the things. And now, if you listen to what the head of legal of GIPC said, there are certain types of, you know, clauses that must not actually appear in the agreement. If they are put in there, obviously issues will be raised by the regulator, and these are the unenforceable, you know, clauses which the regulation has actually, you know, outlined. So Abeku, in a nutshell, these are some of the things. In fact, the parties could agree on other clauses that will have to be included in it, but the key ones are the ones that, you know, I've just mentioned. And so clearly, this is what it is. Thank you.
All right, so thank you very much, Michael. Just to recap, some of the key content, terms, ingredients, elements that we should find in that registered technology transfer agreement includes the fee, includes commencement, includes governing law, includes training program. And you also made mention of some matters regarding disputes. So I'm going to explore each of these for the sake of our audience. But before that, let me quickly go to NAV for some additional comments. Now, I am dealing with the GIPC. I am not happy with the decision that is being made by the center. I'm not happy that so much time is being taken to get my approvals done. I'm not happy that the approval is frustrating my efforts to have a simplified approach to dealing with transfer pricing matters. Now, what can I do? Who can I complain to? How do I get my unhappiness converted into happiness? So if you could please help address these questions, I guess my audience will be glad, because as Kinsley said, he's never been able to successfully get any of his clients go through the simplified approach in dealing with transfer pricing documentation. What should we do? And who do we appeal to? Thank you very much.
Thank you very much, Abeku, and thank you to Michael for very aptly summarizing the elements that should be in a TTA. Before I go to the questions you just asked, Abeku, I want to touch on a bit of what Michael just said. So the TTA is a contract. So in essence, it must follow the regular format of what a contract is. And this is normally standard for both common law countries and civil law countries. Now, the elements that must be in the agreement are what is in the LI. There are other elements that are usual in most well-written agreements, but are not required by the GIPC. So for example, you mentioned force majeure. Force majeure is not a required element in the TTA by the law, but any lawyer where the assault would put a force majeure. Indemnity also is not necessarily required by law section in the contract. Same as definitions. It's very helpful to have a definition section in your TTA, but it's not a legal requirement. So, as has been mentioned before, there are some extremely key legal requirements which is listed in the LI, some are in the Act, which must be within it. Others are helpful and are best practice in contract drafting to let the party reading it or interpreting it have an easy job of understanding what the parties are looking for. So on the question that Abeku stated on the decision, you see, we know very well for many of our esteemed clients that the time it takes to register an agreement is of concern to them. The answer to that question or the solution is a very, very simple one. If the documents that are received by the GIPC have met each and every one of the elements that Michael has so helpfully elucidated, we are talking about weeks, not months. But Michael himself and many of the clients here would acknowledge that majority of the documents that come to us do not have these key elements. And that is the reason why many times these documents seem to take a long time. So basic issues governing law is the law of England and Wales, for example. Description of the services, very, very vague services. Commencement dates, they fixed in their own date. Duration, they'll say it's renewable automatically. So majority, and I say this in all good faith, over 90% of the documents that we receive do not have all the key elements that the law states that they should have. So we are working hard and we've done a lot of work with our PR department to put a lot of information on our website. So if reading the law is tedious, the website has a lot of information on all these elements and how they should be incorporated within the document. So if the documents that we receive at the onset have all the elements that Michael has stated with the clarifications I added, it would be a very, very, very straightforward, almost stress-free, pain-free process. So you have written to us and the decision is that the application has been declined. The first practical step that we advise is that depending on the issues, we would normally have a meeting with the client or with the agent or both the client and the agent to explain why the document was declined. Would write a letter and have a meeting. But sometimes, depending on the amount of work involved, we're unable to have a meeting with every single client before the letter is sent. When the letter is sent, please come in and unless it's fairly self-explanatory to you, you have any questions, call, send an email, walk in, we'll have a virtual meeting or a physical meeting, and we'll walk you through the issues we've identified. And in many instances, with the explanation from the client, many issues are readily resolved. So practically speaking, if you receive a decision from the center, and decision, I mean a letter saying that the document has been declined or is going to be registered because of A, B, and C, please, if you need further assistance, please let us know. But the most important step is that before the document is submitted to the center, whether it's an in-house counsel, external counsel, an accountant, an auditor, an expert, whoever is helping you to put the document together, before submission, please avert yourself to the key elements in the document, which should be within it before it's submitted to the center. so that we don't have to have a back and forth with you. Once the document has all these elements, it's a very straightforward matter. So who to see? So the legal department is primarily responsible for registering these TTAs. Our contacts are available online. I don't mean our personal contacts. I mean how we can be reached is available online. You can reach us through the website. When you log into the website, there's an option for you to type in a query. It will come to us. You can call, you can email, you can walk in, can set up a meeting. I'll be happy to discuss with you what the issues are. What will be most helpful is that from the very onset, before the document is submitted, we are happy to have a discussion with you about what you are looking at, whether it's a TTA or not, some of the key provisions, whether you are not sure about how to draft it, or what you have in mind, what is our opinion, whether it's a TTA or not. We're very happy to help you prior to submission of the document. And we must say that clients who have met with us who need some reassurance or need clarity prior to submission have had the process extremely shortened, because when it was submitted, it was about good to go. So from processing to registration took a very, very short time. So our doors are open. You have questions, you want clarity, we are very happy to assist you with the document. Have a discussion with us prior to submission. And if you are using an agent, with the greatest of respect, whether it's a lawyer, a law firm, it's helpful to find an agent who actually understands what TTAs are. There are agents who may tell you, oh, I can do this for you, and then they themselves are starting from ground zero. So they are sent document to us, and they are starting from ground zero to learn themselves how the process is done. So it's not a rocket science whatsoever. It's fairly simple. We are here to help. So if you're unhappy with any decision, please let us know. We'll be very happy to explain and clarify and work with you to resolve the issues towards the finalization of your application. Thank you.
Thank you very much, Na. So maybe in one sentence, if I'm not happy with the legal department and how they are pinpointing with my agreements, approval, or registration, who do I speak to?
You speak to the legal department.
Okay.
We are the people on the ground. Now, hold on. From a legal perspective, let me say, from a legal perspective, there's a formal, and it's, since we asked about appeals, the GIPC Act has a provision on appeals against the decision of the center. So there is a formal mechanism with the GIPC where you would write to the board of the GIPC within 60 days to get a decision, and it will go to the board, and the board will have a committee that will sit on it and so on. But for the purposes of expediency, it's helpful if you just deal with the legal division and the issue will be resolved.
All right. Okay. So very key points made by Na, and I will come back to explore various aspects of it. A TTA is essentially a contract between the transferor and the transferee. However, there are certain elements that ought to be included, and that is what may delay or ensure a speedy approval of your agreement. Coming back to the table, to the right of our slide, we can see that in one instance, an entity paid tax or income tax of $250. In another instance, 4,000. In the last case, 9,000. For the entity that paid 9,000, a critical thing is that if you look on the row for general and admin expenses, which is the conversation that we are having today and how we can simplify our lives rather than going and preparing detailed transfer pricing documentation, you see that what has happened there is that the G&A expense in there was zero. So let me quickly attempt to give a bit of background, and then I will invite Moses and Kingsley in. So some years ago, when the GRA comes to audit, The position that they held was that if you have an agreement, that should be registered with the GIPC. And that agreement is not so registered. The GRA would disallow that expense. It doesn't matter whether it was necessary for your business. It doesn't matter whether it was important or not important. As long as you don't have the agreement, the expense was disallowed. A taxpayer was bold enough to challenge that position in court. That taxpayer is called Beiersdorf. People like calling the case the Nivea case. The case went to the High Court and the GRA won. In other words, the judge said the GRA stance was correct. The taxpayer boldly goes to the Court of Appeal. The Court of Appeal overturns the High Court's decision and says in clear terms that you do not need to have a GIPC agreement to get an amount that should be allowed for income tax purposes. That ruling was done as far back as in 2019, 2020. However, there are some practical challenges. And even though I wanted to go back to Moses, maybe I'll come back to Michael and now before going back to Moses. The practical challenge is that some banks hold the view that for me to remit an amount that should have been registered or that should have been acknowledged, that should have been known by the GIPC. If you do not have that registered agreement, I would not permit you to remit that amount. So you have instances where taxpayers can accrue the amount in their books. Taxpayers are clearly using the brand of a non-resident to trade. They are getting management and technical services, but then they cannot remit. So now coming back to you, if a TTA is essentially a contract and the TT regulations of 1992 permit that parties can include a commencement date in their agreement, and following the ruling of Beiersdorf and the Commissioner General, will it be fair to say that one, the GIPC may be frustrating the ruling of the Court of Appeal, that taxpayers should get their benefits? Two, would it be correct to say that if the GIPC works with me and it takes a year to approve my agreement, but so long as I have a commencement date in my agreement and it's been established on this call that the regulation is still in force, then all my accruals can subsequently be remitted? What is the view of the GIPC on such matters? Thank you very much.
Thank you very much. So I wanted to put one foundational issue about the commencement date. The rules on the commencement date are not in the LI as stands right now. The rule on the commencement date is in the Act itself, which is superior to the LI and latest in time. So let me read. So the Act itself, not the LI, is now what we look at for the commencement date. So the commencement date as per 37 of the Act says that a technology transfer agreement registered under this Act comes into force on the date of the registration. So it's not about the LI whatsoever. It's the Act itself that says specifically the commencement date, and the date is when it's registered by the center. So if you put in your own date, that is not relevant whatsoever. It's the date that the document is registered with the center. That's the effective date or the commencement date. So on the basis of matter and an apparent consistency, at the GIPC, we do not see an inconsistency when it comes to the commencement date, because as we said, the law states that when you register the document with the GIPC, we issue a certificate. A certificate has on the surface a start date and an end date. That is what matters. So we have told our clients many times that it behoves on you to timeously, and I repeat, timeously submit your application to the GIPC, knowing that depending on the complexity of your documentation, it may take more than a few weeks for us to register the documents if it's in good order. And if it's a renewal, we require the approval of another state institution, which was further lengthening the time. But in our experience, in some occasions, the company is in haste to get his or her bank to transfer the monies out and wants the registration done in days. And respectfully, that is highly unlikely. Now, for the bank's position, so we worked extensively with Bank of Ghana on this matter. The Bank of Ghana has periodically issued instructions to all the banks that if your client seeks to transfer monies that are to do tele transfer, these sums of monies must be under a certificate issued by the center. Now, this does not necessarily frustrate the client because the client has the obligation under the law to submit this agreement well in time for it to be registered. Not wait, have the agreement, receive the services, prepare to transfer the money, find out that this is actually a requirement, run back to the GIPC in a panic and say, can you quickly do this for me? So this is a requirement that has been on the books since 1992. So we respectfully tell our clients that this is something that you should have been informed by your agents, by your accountants, your auditors, your lawyers, your consultants, that this is a requirement. So yes, the banks will say that if you don't have an agreement as mentioned by the center, we may not allow you to transfer the monies out of the country. Now, two things happen here. Sometimes the banks will write to us to confirm whether or not agreement between company A and B has been registered with us. It will confirm yes or no, or the company itself will write to us. Sometimes the company would dispute the claim that is a TTA. We get that also very often. And we are very happy to say with the client, and we have on occasion written to the bank, written to the client, written to BOG that this is not a TTA. Please allow the client to send the monies out as they so wish. So we have engaged with banks and clients readily on this matter to ensure that they allow monies to go out of their systems if indeed it's not a TTA or if there has been some registration. So as you said, your monies have accrued and you are seeking to send the money out. So respectfully, the first thing that a company must do is, if it does not know so already, as soon as you set up in Ghana or as soon as you want to receive services from a party outside Ghana, the first thing to do is to come to the GIPC and submit the agreement well ahead of time. We repeat, well ahead of time. But if you receive the services, you are paying for it, or I want to pay for it, and then you come to the center asking for us to quickly register it to send the monies out, we'll have to still review the agreement. That will take some time, and your monies would accrue in the bank and cannot be sent out. So once again, please send the documents to us ahead of time, engage with us ahead of time, prior to the receipt of the services, prior to payment of the services. Then by the time monies are being sent out, all your ducks are in a neat row and there will be no issues whatsoever. Thank you.
So thank you very much, Na. So the message from the GIPC is clear, that from the GIPC's perspective, notwithstanding what is contained in the LI, the position of the center is that the effective date for the agreement, and of course, the date in respect of which funds may be transferred out is the date indicated on the certificate. Hence, try and engage early on to avoid such an instance. But the center does respect the ruling on Beisdorf. Coming back to Moses and maybe Kingsley, following from what Na has said on commencement dates and fees, how does it affect transfer pricing matters? If a taxpayer walks to you and says, I want to accrue and I want to remit, I'm having delays from the GIPC, what would be your response, Moses? Thank you very much.
Thank you, Abeku. Yeah, so in terms of a client of ours, for that matter, GIPC, have an agreement for services that qualifies to be TTA, and they are looking at registering or getting it approved. So far as deductibility for income tax is concerned, we from the GRA, for now, we do not bother too much on GIPC registration. The starting point is that the said fees, if accrued, should meet the requirements under Section 9 of the Income Tax Act. That is specifically, the said fee should have been wholly, exclusively, and necessarily incurred in the generation of the income for which the said fees will be deducted on. So that's the starting point. And then to the extent that the agreement is with a related party, which we describe as a person in a control relationship, that means that the requirements of transfer pricing is triggered. And for that matter, the said fees, either under an agreement approved or not, has to meet the arm's length requirements as provided under Section 31 of our Act. And for that matter, if it is dependent on the service IP or in this case, royalty, you have to meet the requirements under our transfer pricing regulation. And so the issue of either the agreement is approved or not, for us, the income tax requirements are there. And then the transfer pricing regulation is very clear about that. So even prior to the Beisdorf judgment, the transfer pricing unit, we have always looking at it from the point of the arm's length requirements. Was the services even necessary in the first place? Was the services provided? Will a third party under the similar circumstance pay for the amount that is being charged? These are things that we, bother our minds on, and not either registered or not registered. The issue of being registered with the GIPC comes to play when you intend to enjoy the safe harbor provisions under our regulation. And for that matter, once the agreement is not registered with the GIPC, then you are not required, you are not even qualified to even apply to enjoy the safe harbor provision. So irrespective of whatever dates you put in your agreement, it is inconsequential. The first step is that you need to get GIPC to register your agreement before you can even submit it to the Commissioner General by electing that you intend to benefit the safe harbor provision. I think Kingsley mentioned the issue of the 30 days from the commencement. You'll have to look at the regulation and look at the practicality of it. The regulation provides that within 30 days of the agreement coming into effect, it can only come into effect when the agreement is approved by the GIPC. If you sign your agreement with your head office and it hasn't gone through the approval processes, it is still like a draft stages. So far as the Act 865 is concerned, and for that matter, LI 1547 is concerned, it is just a document that you are contemplating to have into effect once the center approves it. So in terms of accruals, for us, we subject it to the requirements of the Income Tax Act, starting from Section 9 up to the entirety of the transfer pricing regulation. And for that matter, the benefit test, or what we can say the arm's length test. So from the GRA point of view, your technology transfer fees must pass the arm's length test and the other general requirements for deductibility as provided under our Income Tax Act. The issue of registration to enjoy the safe harbor provisions, yes, it's a must. And once it's not registered, you cannot enjoy the safe harbor provisions. Thank you, Abiko.
Right.
If you have any further questions.
Thank you. Thank you very much, Moses. So let me go to Kingsley with a background, and Mike can also chime in later. The Ministry of Finance has a seat on the GIPC board, and it's currently the person sitting on the seat is one of the deputy ministers of finance. The GRA can be properly described as an agency or as a body supervised or under the Ministry of Finance. The safe harbor provisions that Moses kept talking about gives a cap of 2% of net profits, in that if your fee exceeds 2% of net profit, then you cannot even enjoy the simplified approach to complying with transfer pricing rules. Kingsley, you may have noticed that except for management service fee, which is determined by reference to profit before tax, and Michael did talk about the fact that that percentage may even be reduced depending on your level of ownership. All other fees in the technology transfer regulation are referenced to net sales. So just to repeat, if you look at the technology transfer regulation, except for management fees, and even for that, there's a variation. All fees are referenced to net sales. However, the safe harbor rules references net profit. What advice would you give a client or a taxpayer who gets approval by reference to net sales from the GIPC, probably a very small amount, maybe 1%, but then may have practical issues dealing with the GRA because GRA would be looking at net profit? Kingsley, what advice would you give to a client to navigate through this maze? Thank you very much.
Thank you, Abeku. Yeah, so you've aptly described the difficulty that these two laws have created in terms of the base on which these amounts are to be determined. But there's also some definition, if I may put it that way, in the various laws. So net sales is defined in the GIPC, in the LI 1547, 1992. And profit before tax is also defined in LI 2412. The net, I mean, if you look at it on the face of it, net sales in accounting terms is definitely different from profit before tax. Okay, but because we are dealing with laws in construing these terms and not necessarily their ordinary meaning, and given that some definitions have been given, you need to go to the law. So as far as the TP regulation is concerned, when they say 2% of profit before tax, it is defined to mean your earnings after interest, tax, and then other expenses, but excluding the technology transfer fees you paid out. So if you take your financial statement and you've determined your profit after tax, you need to take out or add back rather. So you need to add back the technology transfer fees you've paid and then calculate 2% of it to see whether it's consistent with the requirement in the transfer pricing agreement. If it is within it and you are still within time, you can then apply for the exemption under the transfer pricing regulation. If it is not within it, you would have to fall under the other provisions, which is preparing the detailed transfer pricing regulation. And as when Moses was speaking, I think one key point that perhaps maybe didn't come out clearly is that, look, this safe harbor or the exemption or waiver from preparing the documentation is just relieving, it's a relief from submitting a document. But that relief from submitting a document doesn't mean that the Revenue Authority cannot actually prevent you from claiming a deduction of the expense. That power, that right to interrogate an expense you've incurred and come to the conclusion that it is deductible wholly or partly is still retained, even in the face of the provisions that we have in the transfer pricing regulation. So, and also GIPC, GRA are two regulators, separate regulators with technical statutes. GRA is implementing all the laws listed under the GRA Act, whilst GIPC is regulating, or they're basically enforcing the GIPC Act. The GIPC Act will prevent payment, transfer, if you don't have registration. But the GRA Act is actually looking at whether they should grant you deduction for an expense you've incurred if it qualifies as a technology transfer. And it is very clear in the Income Tax Act. What the TP regulation is doing, the safe harbor is giving you, is just reducing your burden of submitting additional information. And in the absence of you submitting those additional information, the Revenue Authority can still look within. So mine is, and to my clients, will be, you need to strictly look, you need to separate or put these issues in two baskets: deductibility and, if you like, submission or giving information to GRA. Deductibility, you must by all means still prepare your records internally to meet it, because you are not, immune from it. But disclosure-wise, or that submission, burden or obligation, if you walk through the process and you meet it, fair enough. Now, the inherent, I think, disparity or variance, as you rightly identify, as far as the terms are concerned, has been of concern to many, because on the face of it, there's profit before tax, even though if you look closely, profit before tax has been defined to mean earnings or profit after, really loosely in accounting terms, your profit after your tax, but without taking into account technology transfer agreement. Now, when NA and GIPC are really approving, they'll be looking, or they will do a blanket approval, your net sales. They will do a blanket approval apart from management fees, as you rightly indicated. But I mean, I'm submitting also that even for management fees, it is stated that if a running cost or a lump sum amount can be appropriate in a given circumstance, they can give that approval. You know, so for management fees, you can have a lump sum or fixed amount, or you can have the profit before tax. But for all the others, and really the Tony's, I mean, issue here is on know-how and royalties. As far as transfer pricing is concerned, global best practice will have royalties stated as a percentage of sales. Now, the GIPC Act defines the net sales in terms of products as what? The ex-factory price less taxes. Okay, but for services, it says what? The net income. And I know in one instance somewhere, someone has argued that as far as services to GRA is concerned, is the net income. So they are working their way, even using the GIPC Act, working their way back to profit before tax. That is a net income less any, how do you call it, taxes. What is net income? So Abeku, the question you ask is, it appears very simple, but not straightforward, given the disparities or change, the use of different terms. But for me, the key is, look, if you can't meet what is stated in the transfer pricing regulation, as in the definition of profit before tax being profit after tax, but not deducting technology transfer agreement, and you can work yourself within the time limit set, you should be able to make the application for purposes of not preparing ATP documentation. But if you can't meet it, no worries, you would have to prepare the documentation, because in any case, whether you submit documentation or you don't submit, Moses is sitting there waiting for your return and will look at deductibility without reference to whether you have approval from GIPC or not. Because one of the criteria for you being given deduction is whether the service was actually rendered. So it doesn't really matter that GIPC has approved and it is within the 2%. If you've not actually received the service, or the service doesn't, the service is actually service that you should not have even paid for, GRA will not grant you the deduction. You know, so that's what I'll be telling my clients. I'm happy to take up any follow-up. Thanks.
All right, so thank you very much, Kingsley. And our esteemed audience, very soon we would give you the opportunity to ask questions, probably even give you an opportunity to ask it orally so that you can participate a bit more active on this, and then let both the GRA and the GIPC get to know what your concerns are so that we can fix these issues. In all this conversation, we should be guided that the GIPC Act is one of the laws that is described as administered by the Commissioner General. If you want to be very precise, it is one of the laws that is partly administered by the Commissioner General. And the other laws we're looking at may be fully or partly administered also by the Commissioner General. And let's also not forget that unless things have changed, and probably now would correct me, the GIPC sits directly under the office of the president. The GRA, as you said already, sits under the Ministry of Finance, with the finance minister being a cabinet minister. And I am not sure that they would want a lot of the laws to have some real or apparent conflicts. And therefore, such sessions that are hosted by the GIPC are meant to support the creation of a more conducive business environment. So if things can be made as simple as possible, why not? Complexity should only come in when it's really necessary to address some particular issues. Michael, coming back to you, you talked about the issues of fees and guidance provided in the Technology Transfer Regulations of 1992. We've heard Moses and Kingsley talk about issues around deductibility. And what led us to this point was the whole issue around simplified documentation and what others may call safe harbor rules. Michael, from your experience in assisting clients register the agreements with the GIPC, do you encounter or do you advise that clients should present a transfer pricing documentation to you, giving an indication of what fees will be charged before going to the GIPC for evaluation? And then two, for clients that would want to enjoy the simplified approach, because every tax system has desirable properties, including one of simplicity. Will the GIPC, based on your experience, say, in dealing with, say, know-how or dealing with, say, technical services, or say dealing with royalties, be prepared to link royalties to profits rather than royalties to net sales as presented in the Technology Transfer Regulations? Thank you very much.
Well, thank you, Abeku. Yeah, this is quite a dicey question, but probably to take it from where you left it. Yeah, if you look through the law itself, the Act 865, and of course the LI 1547, clearly issue about TP doesn't appear there. However, of late, when we present documents to the GIPC and they provide their input, one of the things that they will also request that we include in the agreement is the fact that whatever fee that is actually agreed upon, will be subject to a transfer pricing requirement, which of course will be, taken on board. So, and as it has also been extensively, discussed, although the rates are there in the LI, the GRPC will, of course, approve it once it falls within the threshold. However, when the client should get to the GRA, there are going to be problems. And so your question as to whether, if we are considering an agreement for registration, we should request for a transfer pricing document. Well, I would say that, okay, probably yes, because it's a service that we are providing to the client, and we don't want a situation where we provide a service, get the approval, the client gets to the GRA, then there's a problem. So as much as we can, once we have the resource to be able to look at the fee or the range of the threshold of fee to be considered in the agreement, and then also we also match it with the transfer pricing documents. If we see any form of inconsistency, then probably we can sit back with the client to discuss it again and see whether probably we would have to take a look at the rate that is being decided on in the agreement. Hopefully, if we do it that way, then one will end up getting approval from the GRPC, and then at the same time also meeting the requirement of the GRA. So I would say yes. I think it makes sense, to do that clearly. But as to whether the transfer pricing documentation will be forwarded to the GIPC, I think at that level, I don't think it's something the GIPC has ever requested for. And so until they request for that, I don't think it will be necessary for us to forward the documentation together with the application to the GIPC. Probably the transfer pricing documentation will stop with us as probably practitioners or maybe at the firm trying to help the client. And so I think this is where it will have to be. I don't know whether I've been able to respond to every aspect of the question that you have asked.
No, Michael, thank you. I think you have, but for completeness, let me move over to now. So now, my question to you is, in your role in looking at transfer pricing, in looking at technology transfer agreements and the processes that you go through, what do you look at in certain what one may call an acceptable fee range for applicants who want the agreement registered? And then two, do you request, what additional information do you request to give you comfort that the fee is reasonable? And then maybe three, does transfer pricing documentation play any role in the process of approving the agreement containing the consideration for the intellectual property or for services that would be provided under technology transfer agreements? Thank you.
Thank you very much. So before I go to your questions, please allow me to touch briefly on some of the comments made by esteemed colleagues on the call. So we've been asked many times that there seems to be a conflict between the GIPC law and the GRA law when it comes to TTAs and transfer pricing, and that the two of us are working at cross purposes. And we've been at pains, and Moses knows this, to clarify to clients that there is no inconsistency per se between the two laws. It's a matter about the administration of the laws. As Michael has said, when we write to you, we always put in our documentation invariably that compliance with the GIPC Act does not mean you should not comply with other laws of Ghana. And that is actually in our law itself. So we tell you that in submitting your documentation to us, the law gives you a range, 0% to a particular percentage, and a lower limit and an upper limit. You are free to choose whichever percentage of your net sales or net income or profit before tax that you so wish. But kindly note that transfer pricing may be an issue. So the burden is on the client to ensure that whatever fee they choose within the range will also work with their transfer pricing applications and documentation. So we will not insist that you should choose 1% or 5% or 6%. The range is there for you to choose from, but bear in mind that it may have repercussions on transfer pricing applications and documentation. So you have the responsibility of choosing the appropriate figure to use in your agreement. Then when it comes to deductibility and other things, now, the issue that has been mentioned a lot here is about enforceability of the agreements without GIPC registration. I would not want participants to go away with the idea that, well, if GRA for the deductibility will not look at GIPC registration, then I might as well go ahead my merry way. There are serious consequences for not registering registering your TTA with the GIPC. The first is that if you do not register it, the document itself is unenforceable, meaning you have an agreement, it has been signed. Typically, if a contract is signed, that should suffice. But in Ghana, if you have a TTA signed, nice looking, but you don't have GIPC registration, that document in itself is unenforceable. meaning that you provide the services, the client refuses to pay, or the transferor doesn't provide the service, or any dispute, you've been hot waters. And there are actually cases right now pending in court where the parties didn't register the agreement, issues have arisen, disputes have arisen, and the document they are relying on is unenforceable. It never came into effect. So please note that. The second is that under the GIPC Act, you cannot transfer sums or funds under unregistered agreements. So if the document is unregistered, and perhaps GRA allow you deduct the relevant taxes, the bank and BOG may not allow you to pay those fees to the person who provided you with the services because the document is unregistered. So the adaptability is one issue, but please be minded that there are other repercussions for non-registrability of TTAs. So the issue to do with the fee range, as said before, the law gives you a range, and we generally will not interfere with the client's decision of choosing a particular figure within that range because the law gives a range. Sometimes you see a situation where the upper limits of the thresholds are chosen. But if you look at the scope of the services to be provided to the local party, it makes you wonder that the value of these services is not as much as it appears to be. In that instance, we will discuss with the company that you have chosen the upper limit, but your services are very, very few that you are receiving. Can you explain to us the value of what you are receiving and what you are paying for? In addition, the law actually allows you to go beyond the thresholds. So in limited circumstances, clients can actually apply to the center in a separate application for fees higher than what is within the thresholds. And that's a separate application. There's no particular limit to how much you can pay, so long as you make a justification to the center that in my particular industry, I want to charge, let's say, 10% or 20% of my profit before tax or management fees or the like. So it is possible. The next is about the role of transfer pricing. So we do not ask for the documentation to do a transfer pricing. All we tell you in writing, and also in discussions like that, consult internally with your experts and your consultants on whether you wish to go under the safe harbor provision or any other procedure, and have that in your mind when you select the appropriate rate of fees under your agreement. But once that is done, we will not be able to weigh in and say, GRA, please allow them to use the safe harbor rule because GIPC registered it. That is the purview and remit of GRA, and they will use the figures that they find. A last point is about double taxation agreements. In the event that the country, the provider of services, has a DTA, double taxation agreement with Ghana, that agreement signed between the two countries may have specific provisions on fees that can be charged. Sometimes they are higher than what's under the law. They may have rates of withholding taxes that can be charged. So double taxation agreements may also have specific language which prevails over the GRA law and the GIPC law if the providing company is within a jurisdiction that has such an agreement with Ghana. So would urge companies to also look at that as well, that if the provider of the services is from a country has a DTA with Ghana, there may be provisions in that agreement that may prevail over the GIPC Act and the GRA laws because it's a treaty. So that in some way is our position, and we are working very cordially with the GRA in this regard, and we will continue to do so. Thank you, Abeku.
Thank you very much, Nalamde. Now, do you have an internal work that have been done? Because a couple of years ago, you introduced this GIPC T1 form, which is essentially a checklist of what ought to be completed to facilitate TT approvals. Do you know how that has worked? Has that improved the rate at which applicants get their approvals done? If not, should a GIPC be considering maybe template agreements? So for instance, if I want to set up a company, my Companies Act provides me with some guidelines on how, say, a constitution looks like. And I can pick up that up as a starting point, make necessary modifications, and then decide to submit, and then submit that to the Registry of Companies. Is this something that the GIPC can consider? Because as you rightly said, there are agreements that go for months, sometimes for years, before they are approved. Is this something that the GIPC may want to consider to make life a bit easier for, as you keep describing them, your clients, etc.? Thank you very much.
And thank you very much, Abeku. So our key job as GIPC is to provide a facilitatory environment for investors in Ghana. It is our job to encourage investments and make sure that your experience in Ghana during the life cycle of your company in Ghana is as pleasant as possible. So we continue to engage with clients, receive their feedback in ways in which we can improve our services to them and ensure that these applications are done as timeously as possible. So in the steps to ease the process and make it easier for clients to go through it as quickly as possible, the first, as I've said many times before, is to ensure that what the elements that have been stated several times in this meeting are in the agreement. Now, if you go to our website, and it's a very, very good website, if we say so ourselves, you'll find a tab on TTAs. No, it's a very good website. It has a lot of information. So
I know, don't mind me.
So there's a tab on TTAs. Click on that tab. There's a lot of information on how to submit the form, the forms themselves. There's a manual on the elements that should be in it. And we have been asked many times, give us a template to use. Now, the TTA is a contract between two parties. So if you say a template, we cannot tell you what to receive from the provider of the services. You have decided to go into a partnership or a collaboration with somebody outside Ghana. We can't tell you will receive service A and not service B. That's between the two of you, but we can tell you what should be within. So we'll continue to enhance our information flow, particularly on our website, to create a very simplified list, the list that Michael, for example, enumerated earlier, so that you have it dotted 1, 2, 3, 4, that you will look at and tick. Okay, do I have my duration? Tick. Do I have my this? Tick. So we'll go ahead to expand that manual on TTA registration to list out extensively every single document or provision or clause that should be in it, so that once you go through the checklist, everything is done. It's easier to submit to the GIPC and also to receive the feedback. And also in our practical experience, you see, and I say this with all due respect, majority of the agreements that are sent to us are not drafted by persons with knowledge of Ghanaian law. I didn't say Ghanaian lawyers, because non-lawyers can draft agreements, but majority of the agreements are done outside the shores of Ghana, sent to the local party and submitted to the GIPC. So what happens is that the document has references to other laws. Sometimes it has foreign language in it. It has some French, and some German, some Spanish. And then whenever you have to change a word, literally a word, you talk to the agent talks to the client has to call the regional office or the global office in New York or Geneva or Tokyo. There has to be a meeting at that level before one word can be changed in the document, and it goes all the way back. So sometimes we ask that the local agents or local counsel, whether in-house counsel, external counsel, whoever it is, be empowered, knowing that this is someone in Ghana who understands Ghana law, would have the authority to make sure the document is as in good order as possible before it's sent to us. And they have the powers to also make amendments. But a lot of the delays are because before one word is changed, and I'm not exaggerating here, before a sentence can be changed, it has to go back to the group company for them to agree before the local company can change anything in it. And we have to sit down and wait till that is done before we proceed. So we look forward to engaging with our clients. We really want to receive your feedback towards helping us to improve the services to you so that the process is as streamlined as possible. Thank you, Abeku.
So thank you very much, Na, and I will be putting some questions to the audience very soon. But before that, now let me just get your thoughts on this just for a minute so that I can open up for people to ask questions. You did mention that if a document qualifies as a technology transfer agreement, but it's not registered with you, the document is unenforceable. The context of transfer pricing conversation is that I'm talking about related parties broadly. Moses may describe it as controlled persons acting under controlled relationships as a more technical definition. Related parties would typically tell you that, look, I am concerned about what happens from a good perspective. I don't have an intention to sue the entity in Ghana. So I really don't care about whether it's enforceable or not. Can I please do my business in peace without the GIPC's troubles on that? And of course, you've mentioned the issues around you taking away the guarantee that your law provides for remittance if you have the agreement registered. What would be your reaction to someone who says, I'm dealing with a related party, enforceability is not a concern, we don't intend to sue anybody? How would you respond to that? Thanks.
Thank you very much. So from a legal perspective, I'll be extremely concerned to enter into an agreement with any party, particularly my parents' company or a subsidiary company of the group I am with, which is not an enforceable document. Enforceable or enforceability is not just about can I sue or not. It's about the obligations under the agreement being complied with by either party. So when you have obligations, and these obligations, depending on the agreement, can run into many, many pages. An example is, let's say, trademark. So you have a company in Ghana, you are using the trademark of another company based, let's say, in the US. And then you realize that using trademark X, let's say PwC is the trademark. You find that company in Ghana using a PwC trademark. You have no business calling that company and saying that, well, I have the exclusive right to use the PwC trademark in Ghana. Therefore, why are you using it for your business? The rights that accrue to you to use a PwC trademark are because of the agreement. So the agreements are the core of your relationship. It doesn't have to escalate to a dispute in court for there to be an issue. The document itself, as signed, must be alive, must be effective, must have come into force, so that both parties know what the obligations are and can go by the agreement. And this prevents so many issues from coming up, so much confusion, disagreements, when the document is registered with the GIPC. So we'll encourage all our clients that please ensure that the document is registered. You may argue, well, I've already done some things in the past where monies were sent out or services have been rendered, monies have accrued, what do I do? We encourage you, at the very least, going forward, rectify the issues, let's register the agreement so that at least going forward, you have the peace of mind that from this month onwards, I'm good to go with the GIPC. Everything has been registered. The banks will not raise issues. My auditors will not raise issues. And I have that peace of mind knowing that compliance-wise, I am good. So we continue to look forward to receiving comments and questions from the audience here and also beyond this program towards assisting them to regularize their agreements or to register them right from the onset. Thank you.
Thank you, Na. Your sister agency, the GRA, from time to time, do give amnesties to draw people into the tax nets. Is this something that the GIPC would consider by granting amnesties, allowing people to quickly come and see you, but get their funds transferred out in respect of services or intellectual property that have been used in the past? So this is not to solicit your comment, but is this something that you can think about? I just want to read a couple of the questions that have come in. And for those I direct these questions to, please, if possible, try and just respond in 30 seconds. So the first one says, and maybe Michael, I'll come to you. Please, I joined a bit late. Is it possible to reiterate the definition of a TTA and when such an agreement will become necessary to the point of registering with GIPC? So Michael, you just have about 30 seconds to respond to that so that we can get as much questions through. Thank you.
Yeah,
can you see the questions? As a panel member, I'm sure you can see the questions. Yeah.
So basically, when we talk about TTA, like we said earlier, it is actually an agreement between two parties. Mostly, it is between a resident and a non-resident, where the non-resident or the service provider who is the transferor would provide a service of some sort. It could be with respect to transfer of, industrial property or sale of it. That comes together with, a know-how, or it could be a technical service, it could be a technical assistance coming together with a know-how, or it could also be a management, a service. So basically, it's an agreement made up of any of these, or all of them put together. And so that once it is agreed upon, then obviously application will have to be, made as it has been, said earlier. There is a specific form, and then this form will be completed. It will have to go together with all other necessary documents and of that nature, and then submitted to the GIPC. And so once the agreement is done and submitted to the GIPC, then the GIPC, will then look at it and then get them back with its comment. So basically, a TT is an agreement between parties, having the necessary, clauses that the LI 1547 requires that they should have. Basically,
Michael, when is it necessary to have that agreement registered? When is it necessary? Just a word. When is it necessary to have it registered?
Well, as soon as possible, particularly once, number one, if it's an already existing company, once the decision is made to, then there must not be any delay. Or if the company is now being incorporated, or as soon as the company is incorporated and they know very well that they will enter into a TTA, then quickly they'll have to quickly put together the agreement so that the process can actually commence.
All right, so let me move to now. Now, the other question I have here is a question relating to the duration, the 18 months to 10 years. So the one asking the question wants to find out, does it mean that if the duration of the agreement is 5 years, it does not need to be registered with the GIPC? Thought it's an agreement that transfers technology. So, we said that the duration is 18 months minimum to a 10-year maximum agreement. The person wants to find out, what if the agreement is for 5 years? What happens in that instance? Thank you.
Thank you. So, as you have said, the TTA is an agreement, that's an initial TTA, any period between 18 months and 10 years. So any period within 18 months and 10 years. So whether it's 5 years, 6 months, so 5 years and 6 months, 5 years and 1 day, it doesn't matter. Any period between 18 months and 10 years, it's registerable as a TTA. The client has the right to decide the duration within this threshold.
All right, so thank you very much now. So please don't go and bother our friends at the GIPC if your agreement is for 17 months. And please don't bother them if it's for 11 years. Now, is that what we are saying?
No, that's not what we are saying.
Okay.
So you see, if it's for less than 18 months, then it should be a one-time agreement. That is neither renewable, extendable in any shape or form. So you can't be clever. I'll have an agreement for 11 months. When it expires, I'll wait for a couple of weeks, come up with another agreement for 10 months. No, it doesn't work that way. If it's for under 18 months, one-time agreement, non-renewable, non-extendable. If your agreement is for 11 years, you have to bring it to between 18 months and 10 years. The law allows to renew many times as possible for periods of 5 years each.
All right. Now, in one sentence, please specify which entities or businesses require TTAs for their business.
Any business or entity in Ghana which seeks or relies on services, management, technical know-how, industrial property services from a party outside Ghana for a period of 18 months or more requires a register a TTA with the center.
All right, thank you. Maybe let me go to Kingsley on this. So Kingsley, also in probably just 2 or 3 sentences, please, regarding the range of fees, what happens if the fee to be charged per TP analysis is supposed to be higher based on arm's length than the ranges provided by the GIPC Act? I think Michael addressed it and even now addressed McKinsley in probably 2 or 3 sentences. So the one asking the question is saying, what if, based on my transfer pricing analysis, the fee is supposed to be higher clearly on arm's length basis than the ranges provided in the GIPC Act? What should a person do?
Okay, thank you, Abeku. So for a client or a company or business in such a situation, in making an application to GIPC, the law basically requires you to, if you like, apply or make a justification to GIPC for them to consider approving your rate, which is outside the agreed threshold. So you make separate application to GIPC for its approval. Now,
thank you very much. So Kingsley, thank you. Okay, we'll probably pick the questions later. So let me go to Na here. Madam Na, I think this is the person wants you to answer directly. He says, respectfully, Madam Na's submission seems to suggest that for purposes of GIPC, one may have to arbitrarily choose a range, and then for purposes of TP, go through the processes of ensuring an objective fee. Would it hurt that for the purpose of simplicity and aligning our systems, clients use the same processes for TP to objectively indicate their fee? So now what do you have to say on this particular question? Thank you.
The parties, it's like you're buying the product. You've gone to Makola, you want to buy a product or you want to get a service. You decide how much you're prepared to pay for the service. The person offering acceptance. I'm offering you a service. I want to charge X. You are prepared to pay Y. We'll go back and forth. If there's an agreement, this is what we'll do. So GIPC cannot insist that for these services, you pay this value. It cannot insist that, for example, for a bottle of water, the brand that's on the water should be X amount. That is for the parties to decide. That's freedom of contract. You decide what you want within a range, but just be minded that if you seek to enjoy the safe harbor benefits, they have their own rules to follow. That is why you have that liberty to choose a figure within the range. It's not arbitrary. It's actually helping the client to suit their particular preferences and the transferor and transferee. Choose a figure that suits you and be aware of transfer pricing rules and choose one that fits GIPC and transfer pricing as per the advice of your consultants or internal staff. Thank you.
Thank you very much, Na. And Moses, I know I've not come back to you. Sorry, you and Kingsley, this conversation was not really meant for you. That's why on the flyer we put you at the extremes. It was a lot more a GIPC conversation. So sorry I don't keep coming back to you and Moses. And now let me come back to you on the last question I have here. It says, does the TTA apply to World Bank and groups of the like? Does it apply to the World Bank? I'm not sure whether this requester is coming from the World Bank, but does it apply?
Okay, so the law says applies to enterprises, and the enterprises is defined under the law. We talk about enterprises registered under the Companies Act. Now, the World Bank, as far as I'm aware, is registered as a company in Ghana under the Companies Act. So our law applies to enterprises incorporated under the Companies Act.
Great. All right. So it's two things now. Either I've moderated a session that confuses everyone on this call, or my panel members have done a very good job in making sure everyone understands what we have said. So for those who would like to read a bit more, there are a number of documents that can be downloaded from the internet. So you can find the PwC 2023 Budget Digest and that of the media. We have a business school. You can download the curriculum, join us in any of the sessions, and then we have a tax calendar that gives you the compliance deadlines, as well as a material summarizing taxes in Ghana. But please note, the use of those materials for free without any consideration doesn't mean that, means that if you go and apply it wrongly, you cannot come back to us. So come and then let's do that. So for final words, maybe we say ladies first. Now I'll come to you so that you can end from the GIPC. So let me start with Moses. Moses, in just 30 seconds, what final words do you have for us?
Thank you, Abeku. My final words from the GRA on behalf of the Commissioner General is that, as mentioned, we are working in tandem with the Ghana Investment Promotion Center with one objective, just that we are applying different laws. And to our clients, our taxpayers, my recommendation is that even before you contemplate registering a TTA, ensure that the said services is very much necessary and needed by your business. And before you submit your agreement, ensure that you align it with the arm's length requirements so that you don't have it registered and then the GRA comes to have issues with it. It is possible. You can align it before you submit it. At that level, you are very comfortable. And then after it being registered, ensure that you maintain all the very important documentations in respect of the services that you are receiving. For example, the GIPC will recommend that maintain post-implementation report. So when the tax auditors come to ask you that, give us evidence of receiving the service, you will have something to give. But our experiences has not been good. You are receiving services and then the tax auditors say, give us what exact services you receive, and the taxpayer is fumbling, then you give us reasons that you are doubting that you just signed an agreement and you are not receiving something. Those are some concerns and recommendations that we want to give, that maintain all the evidence. If you have a training plan, put evidence that the training actually takes place, you receive the services and the services was actually necessary. And the amount that you are paying, you agree to pay that to a third party. Abeku, that is my recommendation, and thank you.
Thank you very much, Moses. Kingsley, 30 seconds, your closing remarks. And Moses and Kingsley, thank you so much for joining us last 2 months, triggering this conversation for us to continue. Thank you. But Kingsley, any final comments from you in 30 seconds?
Thank you very much, Abeku. So the registration that is required as far as technology transfer agreement is concerned, right? I mean, I want our audience to understand that it is absolutely necessary because the law provides for it under the GIPC Act, and they should take that very seriously and do the registration. Now, with or without the registration, our audience should bear in mind that they still have compliance obligation under the Income Tax Act, Revenue Administration Act, and then the Transfer Pricing Act. As far as technology transfer agreements, which are, falls within the Transfer Pricing Act is concerned. Now, whether you have GIPC registration or not, you may be able to claim a deduction as long as you can justify that the technology transfer agreement you entered into was necessarily wholly and exclusively incurred in the production of the income for a year of assessment. And if you meet certain requirements, as we've indicated here on the call, or in this meeting, you may then be able to actually have a reduced burden of supplying documentation. But as far as the activity is concerned, Moses, I'm sure, would always come to you, and we are here to help taxpayers.
To answer now.
Okay.
Thank you. Michael, let me reduce yours in 20 seconds. What are your final comments?
All right. So basically, my final comments are that I'm advising, businesses in Ghana to ensure that if they want to present application, they should get in touch with, a firm or advisor that, has the necessary, skills to be able to handle if they don't have one in-house, so that it wouldn't be that they go and then they hit a rock with so many problems before they come back. When it happens like that, addressing the issues and then putting things together actually causes a lot of, a delay. Now, my second point too is there are some of the service that, for example, those with industrial property, like the trademarks that require registration, it takes quite a long time to do them. For some of them, 1.5 years, 2 years, the registration is not out. So those ones, they should be aware of it, so they will start the process much earlier before the agreement are put together, or as the agreements are being put together. So they should take note of this one as well. And then lastly, the decision to put together an agreement and start the process early is very, very key. They shouldn't wait to the last end, or maybe try to make a transfer and then the bank will reject before they start the process. Otherwise, when it happens that way, they will have a lot of the funds locked up which they cannot transfer simply because the services have been provided with a written agreement. So this is what I want to say. Thank you.
Thank you very much. Thank you very much, Michael. In essence, please talk to your advisors, your tax consultants, your accountants, and at least your lawyers to help you get these things right. Now, let me come to you. They keep saying ladies first, but it seems we've turned it around and you are coming in to wrap up. And I know you've done something like this with the GRA in the past. When I look at the number of questions still coming through, the GIPC may want to organize one at a later date to see if there are any areas that you would like to mop up on and see if there are any changes required to our laws and our implementation of the laws. So now over to you. And one of the questions that you may want to just answer as you give your wrap-up message is that somebody is asking whether the rules we've discussed from the GIPC perspective applies to external companies. Thank you very much.
Do I still have 30 seconds?
Now, don't worry, I will give you 2 minutes.
Okay, thank you. Let me answer the question. Yes, so it applies to all types of companies. So once you're a company registered under the Companies Act in Ghana and you have an agreement, it applies to you. And the issues about oncoming questions, we want to reiterate that we continue to welcome feedback from prospective and current investors, companies that have been set up, whether recently or have been in business for some time. Our doors remain open. Please go to our website. It's www.gipc.gov.gh. Lots of information there. Our contacts are there. Our emails are there. We look forward to helping you and assisting you in registering your TTAs. Thank you.
Thank you very much. And to our esteemed audience, thank you so much. I looked at those who started from the beginning and you have more than 90% still remaining. So it means you had an exciting and an interesting conversation. I would encourage you all to follow the various social media platforms of the UK Chamber. And for those who are not yet members and would like to be members, please reach out to them. You can even reach out to them using their social media platforms. And let's continue working together to shape and to build the kind of Ghana that we all want and would all be proud of. Thank you. And that is all for today. Bye-bye.